Good morning, ladies and gentlemen. Happy Tuesday to you all. Today we're going to be asking and trying to answer the question, which bank is next? We're going to be reviewing the top 6 biggest banks in the United States: JPM, Bank of America, Citi, Wells Fargo, Goldman Sachs, and Morgan Stanley. And we're going to be looking at their charts, where they've been, how they've been affected by this massive recoiling in the financial sector, and are any of them susceptible to possibly future downside and any opportunities that we could possibly take advantage of. So without further ado, let's dive into the video. So for all those that don't know what XLF is, we're going to start off there. It is the ETF for the financial sector. Great way to get exposure to that sector without taking the disadvantages of a singular stock. So you get the whole sector's advancement and sheltering when it has a downturn, because you're always going to have overperformers and underperform. XLF on the last 4 days have basically done nothing but sell off. We gapped down the previous day, did fill that gap. Today, we did not fill the gap completely, that we still left between the price of $32.54 all the way to $32.33. So a nice sizable gap, nothing to scoff about. However, at the time of recording this video, at post-market, it is up from $31.63 to $31.88. We have to see how it opens today, because the futures will have affected this, and definitely going to see how if the carnage continues. Now, if we look at the charts to see what we're approaching, we can notice that we're approaching one key trend line along with the convergence of the 200 weekly moving average. You all know my opinion of the 200 weekly moving average. If you break that moving average, it is very bearish for the company, and especially if this being an entire sector, that means a majority of the companies in this sector are starting to approach that line or being around it. So definitely something to throw up as a red flag. Also, with the significance of the volume, you had a mass move down with confirmation of volume. So this is not a move that's necessarily going to get reversed on a low short move volume. This is significant panic. It almost mirrors that of volume capitulation. So if we look back, we're going to use history as an example. When's the last time we had this massive type of volume? Well, if we go back, it's probably in these areas of March 22nd, April 22nd, May, June. What happened in those months? We found bottoms. We found a bottom here, we found a bottom here, and we basically were starting to find bottoms or bounce points on the way down off of the highs that we came off in 2022. What does that play into the market as a whole? It could be a point where we're going to expect to find buyers. This is where I would expect to find buyers, $30.75. I definitely would actually front run it all the way down to $30.98 or $31 on the dot to be exact. That trend line comes from our weekly connect back coming from the COVID lows when we were coming out of COVID, where we had 2 areas of consolidation. We retested it recently on the October low, where you found a bounce off the 200 weekly, and now you should expect to find that bounce again. I don't believe you get to the 200 just because it's under the trend line, which would be a invalidation of the trend line. However, you could wick down and close back up, because it actually, trend is not broken until the trend line is closed below. So you can get the wick, but you need to have the full body close above it. So XLF is mainly in the S&P. What does S&P like to do? Well, the S&P likes to retrace 50% of the move. So if we take the entire move, which I'm going to take from the top of here to the bottom, if we assume, we're going to make an assumption that the trend line is our bottom, right? We're making that assumption because we do find support there. We're most likely going to see a retest, especially with the volatility. We could see it on open, and also CPI being today, it is definitely going to toss a lot of volatility into the market. But we're going to go through both scenarios, where we look at first if this is the bottom, and then we're going to move the retracement back up to this point here to see if it was the bottom. If we get that, we see the 50% retracement kind of coinciding in the region where we have our 50 and 200 daily moving average, 50 weekly, and we want to basically see an area of resistance be met there. You would expect to find sellers there, so 51% retracement there. That would be my resistance point. That comes in at around the $33.71 region for XLF. We're just going to throw a white horizontal ray there just so we signify an important area. That's when we're going to start entering that area. And I'm actually going to take it and I'm going to put it basically down at $33.52, because I want to get that notice of importance there. Secondly, where could we expect to find sellers that where we could find a breakout that could create a bear fuel rally. Basically above the 50% retracement, you'll be above both moving average, significantly reclaiming it, and then you'd probably be heading higher. Also, if we look to see if we have a harmonic on this chart, we had retracement here, retracement like there. We completed that broke through easily. So we really confirmed that a harmonic pattern there, and we just kept flushing. You flush through 2 major support zones, and then you are continuing downward. Now, let's take the theory if this is the bottom of the retracement, then we're a little bit higher than those moving averages, and then the 38% retracement becomes your first resistance point. I do firmly believe that we're going to possibly even wick down below this to assuming, let's say, the $30.63 region, 50% retracement points right at where the convergence of those lines are. I usually have this theory that if you put the 50% retracement right where you have a lot of resistance, let's per se, then that would probably be the bottom. So the bottom could be $30.50. It's also psychological, $30.50, just a nice round number. Just pointing that out there, but this is just me speculating, guys. Don't trade off that. It's obviously do your due diligence. I would be putting my buy orders at this trend line at $31. If we get wick to a $30.50 discount price, I would say that would be an interesting way to dollar cost average down once we get down there. Now, if you close below the 200 weekly, where could we see next support? Well, that's where it becomes a very, very bleak argument, because there is not a lot of price structure back here. There's a lot of gaps, and you pretty much would be the start of the crash leg, and that is when you basically get out. Now, we did cover that in the weekend deep dive, and of why I don't necessarily think the crash leg is here yet. I've been calling for a crash leg, but I don't think we're there yet, and that is specifically due to VIX. So VIX has not closed below the $30 mark. We're actually going to put it right there of where you have to close above. So $30 is where VIX needs to close above in order for me to turn very, very bearish on the market and say the crash leg is officially here, because then we're knocking on the door of 40 on VIX not soon after, which 40 is basically when liquidity is drying up in the market and the true waterfall down starts. Above 30 is when things start breaking, and 40 is when they are completely broken. So with that, link down description below of the weekend deep dive. And just to show you the importance of that weekend deep dive, we called this out on the weekend deep dive where the market was going to bounce. And if you were to look at the low of today of 30.8065, we called out 30.8064. We missed it by 1 cent, guys. So it just showed you the power of harmonics, power of finding this region that we previously consolidated around. It was definitely a good call out. If you traded this, you would have made 2.5% just off this from here to resistance points. Simple, easy trade. So definitely tune in for that weekend deep dive. Hit the subscribe button so you stay tuned to our weekend deep dive content, technical analysis, and fundamental analysis on the chart. But with that, let's dive into the stocks by market cap. So we're going to do JP Morgan first. So looking at JP Morgan, you're below the 50 daily moving average. You're starting to head towards the convergence of all these moving averages down here, sitting around the 124 to 122 price point. Well, why did we bounce here? Well, if you look back here, it is an area of consolidation that you previously had, kind of almost hit that price target right there and came off. This could be a dead cat bounce where basically you're getting a harmonics pattern of A to B, B to C leg coming up here, which projects down to $117. That could be looking like bearish to me. However, if XLF continues to sell off like we've been thinking, especially JP Morgan being a big weighting in it, is definitely going to drag it down. I don't necessarily know if you get a retest of these moving averages down here on JP Morgan. I think CPI is going to be a huge factor on that, but we have to see where the stock could go. If we look at the weekly graph to see if we get any indications, on the week we had our big red flush, and now we're having a doji candle. So usually these dojis, if they close the week out like that, would indicate possibly 50% of the move or a reversal. If that is 50% of the move, you're looking at a 10% move. That would take you down from the current doji. 10% down would be breaking all these moving averages, and you basically come for this gap fill at the 114. So to me, based on the free floatingness of the market, I could put a price target $127 on JP Morgan, but I really want to see how CPI plays out just because it will affect the analysis of this significantly. Now, if you're looking for a bounce retest, we could be looking at the 50% retracement as a nice target. We barely missed that today, coming up to $135.94 as our target, and we came up to $135.28. So very, very close to that target point there, and where we could have found a rejection. However, if CPI comes in hot today, you're definitely going to see all these levels probably get blown out and a massive bearish squeeze rally injected. If CPI comes in hot, then I basically be looking at flushing to the lows. We're going to give you both scenarios real quick. If you get the bear fueled rally, first resistance point, I would say on JP Morgan, $130, $140, which would be your 50 daily moving average. And then probably tackling this upper consolidation here, probably starting at 142 all the way to 134. On the daily, if we're looking to flush the lows, breaking $127.48, first support target 124 on the dot, just because it's the convergence of the 200 daily and 50 weekly moving average. Those levels are blown out. 122.30, which is your 200 weekly moving average. Now, if you break below 122.30, basically abandon ship because you are going lower. You're then probably targeting 114 for shorts, filling this gap fill, and I would probably see the stock coming down all the way to $100, would be about a 30% haircut on the stock as it is. So key level to look out for is that 127 level as your pivot point, and then targeting lower or higher depending where you are. To the upside, I would say break 135. That's your pivot there to the upside, which will probably be ignited by CPI if it comes in hot. Next, Bank of America. Bank of America has a lot of gaps on its chart. We basically almost filled the gap here, leaving about I'm going to guess 1%, about 1.99% or 2% gap there on the chart. And we are closing at the high. Post-market, we closed lower, gapped up significantly on Bank of America. And now you are below the 200 weekly moving average. So everyone knows my opinion of this type of stock is you avoid it like the plague. The way I would trade Bank of America, I want to see the bank actually show me value, and I want to get above this 200 weekly moving average before I inject cash into it. You have a conglomeracy of the moving averages here that are going to start moving downwards as you trade in this lower region. And if we go back to the long-term history of Bank of America, we have not been down here all the way since 2021 February. So that was coming out of the COVID lows. So let's just draw some support levels that we could find, and that's going to be at these levels where we previously had bounces, and try to understand where we could find future buyers. So right here, you notice you wicked down through the $28 level, but came back strongly above. My target, if you could break the $28.17 level, I'd be looking at $26.81 as your secondary target. If you break that, then you're probably looking at $25.21. But I would caution that once you start breaking these lower levels, you're probably in the crash leg of the market, and the bank's basically going to go into free fall, probably coming down to $20 on the dot. On top of, if you look that we have a harmonic pattern completing here, A to B, B to C, completed at the $29 point. And then if we look to see if we have any larger harmonics in play, basically swinging from the swing high up here to the swing low, projecting upwards, completes about $19.88, which would put you right at the bottom of COVID lows. That would be my ultimate target there. You have to be very cautious, and I mean very cautious investing in this bank once it's below the 200 weekly, because it is just basically downside potential more than upside potential. The way I would play it, if it got down to that 20 level where that harmonic completes, I would definitely be picking it up there. However, between the $32 range and the $20 range, I would look to be hands off, even though you could find interesting scalp values. Just simpler to trade the stock once it gets above 32 to have multi-year expansions. And by that time, when it gets back above here, all these moving averages probably converge together, so you get a nice push up because you'd be over all the moving averages. So for now, it's basically a sit on your hands. Next, we're going to look at Citi Group. So Citi Group, you're basically for a long period of time been below this 200 weekly moving average, so it's very bearish. So Citi Group is the third largest bank in the United States, and it almost had a inverse head and shoulders on the daily chart here. However, it failed to hold it. Left shoulder, head, right shoulder, and basically you just flushed it, invalidating the head and shoulders. You also had a failed W pattern here, which 2 strikes already. Now, you're below all the moving averages. That's just bearish. I would honestly treat this like a penny stock. I would not trade this because you're below the moving averages. There's very little support. And it's shocking that we're actually talking about the 3rd largest bank in the United States as the Citibank. Probably all the charts has one of the worst exposures, almost as much as Bank of America. So it really just does show the lack of support in the banking sector. And if we do something similar to what we did with Bank of America, and we draw a harmonics pattern from, let's say, the swing high all the way down to the swing point here, see if we complete here, that completed there. Now let's take maybe a more localized one to see from the swing point here, bottom to there. We're completing around $30.93, which we're starting to see an ominous pattern here that we're probably going to be coming back to these COVID lows. And if you look at what happened around those COVID lows, there is a significant amount of gaps in the chart that we could be possibly taking out. My price target for Citi, just because it's below all the structure, you are most likely breaking this trend line here. That's your long time support. Yep. So trend's broken, basically forming a descending wedge. Just looking at it here, price target off of that wedge, we basically draw to this, transfer it over to where you broke. Oh, $30.93. It's like charts work, guys. I know there's gonna be a lot of people saying that Citi can't keep down here. You have an ascending wedge, you are breaking that wedge now, you have a close below that descending wedge, price target $30.93, and the wedge comes in at $31. So front run it to, let's say, $32. I'm going to throw a horizontal line there so we could reference in the future of where basically the price target is for the company. So definitely bearish on Citibank. And you can see, I'm going to leave this here for future reference of where the price is probably going. And let's jump back to Bank of America real quick just to see if it had a similar pattern to that. If we look at Bank of America real quick, you have what would be known as a symmetric wedge, which broke to the downside, price targeting around the, let's say, $23.00 gap fill here. So probably price targeting on Bank of America right now would be filling this gap here at $23.53 with this wedge targeting down there. We're probably going to be breaking through a lot of these price points here. Next, we're going to jump into Wells Fargo. Now, Wells Fargo, similar story. It is breaking the 200 weekly moving average. That is bearish. So strike number 1, you're below all the moving average, strike number 2. And now you have broken your ascending wedge basically, which if we draw it out here to the tops right here, we're going to be a little conservative with that. And price targeting Wells Fargo would be coming down here, $29 to $30 area, which would fill in this gap and probably come back to this development area here. If we look at any harmonics that could be in play, I could see the from all-time high to swing point low to the upper high here, price targeting at $26.11, which if you got down this low, I would almost be targeting this consolidation level right here, just because it's where previously we found buyers. So with Wells Fargo, I almost be a little more aggressive with my target to coming down to $26.11 because you have not a lot of price structure here. You have significant gaps on the chart, especially once you get down to $26.11. There's a nice gap fill here along with the $22.38. And just so everyone can see what I'm referring to, these are gaps in the charts that have not been filled for a very significant amount of time. And I'm of the believer that most gaps get filled in time. So we could almost go through this entire chart and find different gaps. First gap that you have on the way down is this area of $30.72 to $30.20. And then next, those two bigger gaps that we just mentioned. So if Wells Fargo trades below, and we would have to confirm this pattern by trading below the October low of $35.81, which is encouraging because you just broke an ascending wedge. That definitely puts you in the camp of the bear side below the 200 weekly moving average. So once we confirm breaking there, $35.81, I'd be targeting that $25 to even $24 region on Wells Fargo. Next, we're going to go into Goldman Sachs. So Goldman, basically having similar patterns to all the other banks. However, I do believe based on the chart that we are still holding our uptrend. So this is a company that's basically holding up the financial sector along with JP Morgan. So JP Morgan, Goldman Sachs, probably the two banks that are holding up XLF from breaking that 200 weekly day moving average, probably from breaking that 200 weekly moving average. So definitely something to be on the lookout for. If these two start cracking, then I would expect more downside in XLF because they have a long way to go to those moving average. Where could we see Goldman Sachs going? It's pretty simple. You come down to this 302.75 price point, which is your long-term uptrend basically that you've traded and bounced off twice. You have what on the daily appears as an M right here, which basically will complete down to this downside. You're below 3 of the key moving averages, so you're basically long-term and short-term bearish, and now you're trying to come back down to your all-time support. If this trend line breaks, then we're heading down to these 200 weekly, which I don't personally think would hold up if that occurred. Now, could we see a harmonic pattern playing out here from swing high to swing low, back to swing high, because this is lower than that, it confirms it, break below, we confirm that. Price target of $326, which we already broke, so there's not any harmonic necessarily that's showing us where we could be going. And even if you draw a stretched out harmonic here to the swing high and then targeting down to $257, you could see that happening. You would have to confirm by trading below 272, which is your break of the 200 daily moving average, which at that point we probably would establish a couple more harmonics. So I'm really not going to give that much credence. So with Goldman, the next bounce point that I would say, just looking at where price historically has been, is the 305.68 region, which would coincide with this upward trend line, and then the area that you had previous support on, which is the 283.78. By that time, once you got down here, because remember guys, stocks don't just go straight down, even though they would sometimes, are straight up. That's not reality. You have bounces along the way. You're always going to find those people that are going to try to a bottom tick and top tick. So because of that, it's going to take time for this moving average to get up here. You could be coming into that 284, 283 region, that be your bounce point up, plus it would be a previous area of bouncing. So we would have to see. But right now, there's not a lot of support for Goldman Sachs in its current level. You close near the low of the day, forming a hanging man candle on it. For those that don't know what a hanging man candle is, rope, head, noose, hanging body, right? So just picture it like that. That's why they call it a hanging man candle. And also we closed near the low of the day, so that shows more continuation to the downside possibly. However, again, today is CPI, so that really could move the market one way or another, and we could ignite a bear feud rally trying to squeeze basically all these bears, because you do have a crap ton of bears to squeeze if they are unwilling to relent, and a lot of them haven't. So keep that in the back of your mind, that here's your key support, but if you have a good CPI number, you're probably rallying coming up to this 250 weekly moving average and then the 50 daily. So definitely points to keep an eye out. For Goldman Sachs, the resistance 328, 46, 332, 58. Those are your 2 points that you got to pay attention to. You clear those, 354 is your next target. So you can basically trim your position as you're going upwards and then move your stop loss to break even. Pretty easy trade if CPI comes out bullish. So now we're going to go into our final bank, Morgan Stanley. So Morgan Stanley, similar to all the other banks, you are below this upwards trend consolidation here, broke below it. Now you're heading back down to these moving averages, which is something different than the other banks. Usually they broke this trend line, they're below all the moving averages. So it's a logical place to target of $85.50 to $84, which is where these moving averages are. Next, if we look on the chart on a long-term scale, you are almost forming a very large W that's kind of janky, but now you have broken down below it. So it kind of invalidates this whole W. If you break below these moving averages, which I don't necessarily think you would, because you have a price consolidation area right here where you have previously found buyers and probably would expect to find them again. So just looking at this, the $85 area to $84 area would definitely be an area of price that I'd be looking at. And then if you break below it, obviously probably the low pivot here of $73, and then the 200 weekly as your natural next target, $68. However, you don't see the same volume on Morgan Stanley that you see on the other banks, similar to Bank of America, Wells Fargo, Citi, all those. So this bank, out of all of them, is showing a little bit more strength and kind of off on the side, not really being talked about per se, compared to Bank of America, JP Morgan, like Goldman. Also, the chart is stronger than all of them. So if I were to pick a bank that I'd be looking to, I'd probably be looking at Morgan Stanley, just because their chart looks better than all the others. A lot of the others have very, very, very bearish intonations, but this is a chart that we broke below short-term price movement, and now we're heading towards the longer-term trending price. So could be an interesting buying opportunity on Morgan Stanley for that nice bounce, or it could be for more downside potential, dragging XLF lower. So guys, with that, we're going to conclude the video. If you could be so kind, drop a comment down below of what you thought the video, what you could see improve, what you want to see covered in the future. We always want to tailor this content to you. And also, we would like, if you did like this video, to hit the subscribe button. We provide a weekend deep dive. We cover big news events. We have the live stream tonight, so come in for that, where we take user questions, go over tickers, talk about CPI, all the funness in the market. And if you want to learn more about the stock market, definitely think about subscribing. We do have some teaching videos coming up. So with that, have a great, wonderful rest of your day.